Very good afternoon to you, everybody. Let me just make sure the audio is working. As you come on, if you can see me, if you can hear me, if the audio sounds good, let me know. Please make sure there's no echo on it. It is Wednesday afternoon, it's 12:30 on the live. If you're watching on the replay, it's probably not Wednesday at 12:30, but welcome anyway to this week's live stream where we are having a look at the housing market update. For those of you who are new to the channel, I do a live stream every week to look at the data, the news headlines, and what's going on in the market so we can make better and more informed choices, specifically as property investors. Now, this week was due to be a bit of a slow news week. And so really I wanted just to zoom out and take a breath and see where we are with everything. But do you know what? Everything appears to have gone even crazier over the last few days with the lending market just being ripped up right now. And everything is changing quite quickly. And I don't know about you, but my feeling is that everything that's going on in the housing market is accelerating at the moment. We've been talking about it every week for the last few months. For those of you who've been watching for a while, you'll know that I've been talking about the various possibilities that we can see in the housing market. And the three main possibilities that we can see are the correction we're seeing right now is a little blip before we uptick back up. I've said that's very unlikely. I think right now we can probably get rid of that as an option. The second was a longer but shallower correction, more sort of 90s style. And then the third was a full-on market meltdown. I've always been leaning towards the longer, shallower correction. But with the way things are moving right now, I'm feeling it's going to be a longer but deeper rather than a big crash, right? Rather a big meltdown, because unless a third-party black swan event comes in, of course, which changes everything. But things are changing quite quickly. So we're going to talk through all of that. Now, while we'll do that, let me just put comments box on so I can see comments. Please do, by the way, put a thumbs up, like the video. If you're new to the channel, subscribe to make sure you catch this every week. It's always good to have feedback. And as we go through, please put your comments in so I can answer them as we go through. Okay, so with that being said, let's go to the slide deck and see where we are. Before I go on, I just want to talk about next week's news. We're going to have a lot of news coming in next week. We've got UK HPI, that's the house price index. It's the definitive house price index released next Wednesday, 21st of June. And then, oh my gosh, we've got the big one. We've got the MPC, Monetary Policy Committee meeting on Thursday. It's a week tomorrow to talk about interest rates. We're probably going to be talking about interest rates a fair old whack. Okay, so look, when I put this slide deck together a couple of days ago, it was before a lot of the headlines were coming out about the mortgage market changing. Lots of lenders have been pulling their products over the last few days. Well, actually, the last sort of week or two since the inflation figures came out. And I wanted to have a little bit of analysis and talk about the relationship between interest rates and house prices, because as always, team, right, when we talk about this and we look at the housing market, if you're interested to know what's going on in the housing market for commercial reasons, i.e. you're an investor, you're a developer, you're looking to make better buying decisions, do I buy now, do I wait? We need to look at two things. We need to look at the lagging, probably this way, you probably can't see that. We need to look at the lagging indicators, right, which are things like the house price indices. We also need to look at the leading indicators. And right, a leading indicator right now is interest rates. So I took this screenshot yesterday. Mortgage fears gross. Bank of England expected to raise rates to 5.75%. Right. Blimey, this is, we're talking big figures now, right? We're starting to get into, I don't want to go sensationalist, but quite large interest rate figures that could lead to a much longer, deeper turn down in the property market than we have been anticipating. Okay. It was a mere few months ago where we were talking, well, weeks ago, where we were talking about the current interest rate rise to 4.5, perhaps potentially being the last one, maybe one more to 4.75. In the last few weeks, we've now revised that from 4.75. I say revised. The market makers are betting on 5.75, and I've even seen some people talking about 6% right now. Okay, this is big news. However, how do interest rates affect the market? I want to look at this little schematic. This is since the 70s, mid 70s, the relationship between interest rates and the property market. So you can see in the last 40 years, we've had effectively 3 peaks and drops. Okay, that's not including where we are now. That's 1980, 1990, and the financial crisis. Now, all of those peaks and then subsequent drops are in a period where we have high interest rates. You can see in the 1980s, or at 1980, interest rates was 17%. 1990 interest rates 14.8%. Now, in the financial crisis of 2008, it's a slightly different scenario because interest rates were going up, but then we had the black swan event of the credit crunch. So really, that massive drop was caused by that credit crunch, which is a separate issue to the rising interest rates. But you can see there is a correlation, direct correlation between interest rates going up, property prices going down. Now, it's not as linear as some would say. It's not just a case of interest rates go up, property prices go down. There's other factors at play. And something we're going to talk about in this live stream is all of the interrelated factors, right, that go into the melting pot. Nothing is black and white. Nothing is binary. It's not interest rates up, property prices down. You have to look at affordability. You have to look at workforce. You have to look at labor market. You have to look at wage growth. So, for example, you can see, if you see here, if I just get the pen out, right, we have a peak in interest rates in the mid-80s here. And actually, the property market was booming at that sort of time because there were multiple other macroeconomic factors going. The labor market was very strong. Wages were going up, right? So despite the interest rates going up, the market didn't crash. However, it did there, and it did there, and it did here. But you can see here, right? Interest rates were not that high. Credit crunch caused that. And then, of course, we've got the relationship of interest rates to loan to value, to lending compared to multiples of income. So, when we're over here, lending as a percentage of income, multiple of income was much lower. So therefore, an increase in interest rates has a much smaller effect. But if we just go really broad brush, right, interest rates go up, it affects people's affordability. And ultimately, what people can borrow is linked to their affordability. People can borrow what they afford. And the property market would generally be stimulated by people being able to afford more. So since COVID, right, we've had a lot of free money. We've had interest rates of 0.1%. People have been able to afford a lot more. They've been stretching themselves because debt is cheaper. You can buy bigger properties, right, take on larger mortgages, strong wage growth. People can take more. Now we're seeing a tightening of that. Okay, we are seeing both tightening in policy, so quantitative tightening at a macro level, and interest rates going up. It's taking money out of the system, right? Debt is more expensive, and therefore people can afford less. So therefore, it's just mathematics that when we're in this cycle, okay, or this situation, if people can afford less, property prices are going to come down. Now, what I would like to do in this training or this live stream is I'd like to look. I don't want to be a bear and just go, everything's going to crash, everything's going to be horrible. Okay, that is not a particularly healthy narrative. I want to look at both sides objectively. So I want to look at the side for I think rather than saying an increase in property price in the short term, a softer landing. I think that increase, right, going back to uptick is now off the table. It's a case of soft landing. We're talking a few more percent, 5%, 6%. Are we talking about proper meltdown? We're talking about 30, 35% as in nominal terms, as some commentators are now talking about. So I want to look at both sides of that because as ever, as I said, there's multiple factors at play here. We've got strong wage growth, but we'll talk about that in a minute, versus inflation. We've got an economy that's stronger than people thought it was, but is it? We'll look at that. Okay, so we're going to look at all these factors. As we do that, again, just to make sure that everybody can hear me, if you can hear me, put a thumbs up, just to make sure, and put something in the comments box, as I don't think we've had any so far. I just want to make sure that all of the tech is working. Okay. Biggest thing that we need to understand in the current market, right, is our affordability. This graph here shows, it's first-time buyers, I know, but it shows how right now, right, house prices compared to earnings, even though they've come down, because we have started to go down, in terms of the housing market, right, house prices to earnings are pretty much the highest they've ever been. And therefore, those interest rates, when they come in, are going to have a much greater effect. Right. Before I look at the pros, or before I look at both sides of the argument, I want to talk a little bit about media sentiment. If anybody studies market mechanics, if anybody studies economics, you probably know that it's not just a case of what's actually going on, but sentiment plays a huge part in the process. So sentiment will drive house prices, okay? Without a doubt, it drives any markets. And I would say over the last few weeks, sentiment has shifted quite considerably. I know probably for 3, 4, 5 months now, there's been a lot of commentators saying, ignore what mainstream media say. Generally the property gurus come up and they go, right, ignore what mainstream media says, right? Talk about crash is ridiculous. House prices double every 10 years. We'll talk about that in this live stream as well, by the way. So just buy now. It's always a good time to buy now, right? I disagree with that. Actually, I think the media sentiment has been quite bullish, if anything. Yes, there's talks of correction, but there's a lot of people saying, actually, spring bounce, we've hit the bottom, we're going back up. I'd go far as to say the media sentiment on the whole has been positive, and the stories coming out of that, we're not in for a big correction, and it's just a blip, and we're going to carry on, going up with maybe a 5, 6, 7, 8% correction this year, and then back up. So let's see what we've got out in the media right now. First one that I noticed, and these are all taken. I screenshotted them yesterday. UK house price sits like 10%. Moody's warns. Okay, now that's 10% from now, and we're already. If you look at for example, the nationwide already reckons with 3.5% down over the last 12-month period. Now, whether ONS agrees with that or UK HPI agrees with that, we'll see in 6 months. There's such a lag in the system. But Moody's saying from here, 10% down over the next 2 years. Now, Moody's is probably something, is probably a source that is respectable. Okay, yes, of course, everybody has agendas and they'll have agenda, but really this is what they do, is put out, predictions like this. So as a rating, looking at UK housing property market, 10% over the next 2 years. Capital economics, 12% from here, they're saying, 12% from here, which would probably put us at, 15%. So that was in the media yesterday. Again, yesterday, UK house prices have already crashed 12%, and the worst is yet to come. Another one, how house prices could fall by 30%, right? What this is doing, team, right, is changing the mainstream perception of what's going on with the property market. Now, if we look, I always like to refer to this, the psychology of a market cheat sheet. And in sort of February, March, I was sort of saying, are we, let me just turn that back on. Are we down here? Okay, so have we come down here and bounced back up? So there was a lot of change of sentiment, I would say, in January, February, March. We saw data from Halifax house price index showing 3 or 4 months increase in a row. There was a one-off from Nationwide with one of their monthly indexes going up by a little bit, and people saying, "Look, we're there. We've hit the bottom. We're now back up." Right? And I always said, "Is this a dead cat bounce?" Okay, and it probably looks like right now it is. So, have we come back up, and now are we going back down? And what we find is the compound effect of sentiment, the compound effect of media sentiment and public sentiment starts to accelerate the process. Something that is so important to understand in the property market is how glacial the market moves, right? Literally goes at such a slow pace. It's almost impossible to understand what's going on because our lagging indicators are so out of date. And I want to re-stress, the main thing we are looking at as a lagging indicator, as our main source of what's actually going on in the property market, is the UK HPI, the one from the ONS, the actual sales transactions that have been registered at the land registry. The problem with this is it can be 6 to 9 months out of date, right? Just because of how long conveyancing takes, how long it then takes to register at the land registry. Things that we're seeing now in the UK HPI could have transacted last August, September, pre-budget. So there's such a lag in the system. The Halifax and the Nationwide have got lag, not as much, but it's on mortgage approvals. It's not on actual sales transactions. So those mortgage approvals could well have fallen through by now, right? So they could be in the data but fallen through. The chainsaw fallen through or whatever. And then Rightmove, don't even look at Rightmove. Rightmove is just completely misleading because it's based on the listings in the current month, not including all the other listings that have been on for however long and had price drops. And also it's a different model, right? The other three are something called a hedonic regression model. Rightmove is basically just an average of the listings. So if a load more higher value properties are coming on the Rightmove portal, it's going to naturally skew the Rightmove index to go on. So Rightmove keeps saying property prices go up. Property prices, listing prices, they didn't even say listing, they say property prices is going up. But what's happening is larger properties are being put on the market. More larger properties are being put on the market, which is skewing the listing average to a higher amount. That's not sales. So just ignore the Rightmove one. So my point is, we start to get a compound effect of sentiment, right? And if you think about momentum, okay, so you got, imagine you got this massive sort of, stone that let me just go in here so you can see. Imagine you've got this massive stone that you are pushing, and you're trying to squeeze it, and it's not really moving, and you put all that effort in, it just moves a little bit, right? And then you get a bit more momentum, and then you get to the drop in the hill, and you push it, and it starts going down the hill, and it gathers momentum, and it suddenly picks up a pace faster than anybody realizes. I can't help but feel we're in a bit of a situation like this at the moment, that for the last 6, 7, 8 months, just that momentum has been ever so slightly creeping, just ever so slightly moving. And now we're getting to a part of the cycle, right, where things are starting to accelerate away. And the worrying thing is we won't really know the definitive figures probably for 9, 12 months from here in terms of what is actually going on. Okay, so that's a concern for me. But before we, I'm gonna draw a graph in a little bit and sort of show you what I mean by this. But let's have a look at where we are with the UK HPI from the ONS. I just want to have a zoom out and look at the market. This is what I wanted to talk about, and all the media sentiment and interest rates changing. Okay, if we zoom in on this, right? Oh, sorry, didn't mean to draw on that line. If we zoom on in this, I think it's fairly obvious to see that we have got an obvious topping pattern on this line. Okay, when you look, kind of from here, well, all the way up to here, really, right? There's nothing that represents or reflects that same pattern that we're seeing right now. The last time we see it is here. And actually, if you look at it, right, it's actually almost a carbon copy of what's happened in 2008. Now, you see here in 2008, right? Let's see what happened. You've got, comes down, and then you see a little tick up, and then it capitulates. So it's almost exactly, if I just take that off, right, and just zoom in on that. I don't know if you can see what I mean, right? So we've got topping pattern, starts coming down, little tick up, capitulates. Boom. There we go. Almost to a T follows that market cheat sheet psychology cycle, right? And are we going to see the same here? If we look at this in terms of gradient, if we go to the last crash, sort of end of the 80s, beginning of the 90s, the gradient is much shallower. So you could say already we're going down at a quicker pace in the 90s. Interesting. We're not going to know definitively for another 12 months to see what this pattern looks like. But this is where we are right now, okay? So let's have a look at the two cases. I want to have a look for the case for a property market crash, an actual property market crash. And I think one of the issues with this topic is people have different definitions for what a property market crash is. If you're on right now, right, type in the comments box what your definition of a property market crash is, because there is no specific definition for a start, okay? But I've seen a lot of commentators say they believe a property crash is 10% drop in 12 months. That's a crash. That might be different to a meltdown, but that's a definition of a crash. So we're going to look through the case of a crash, 10% or more in 12 months, versus a soft landing. So we're just going to go down a few more percent, then we're going to have a soft landing and go back up again, right? That's what I would like to do. So the first case for a crash is the mortgage shock we're seeing at the moment. I have, since I started doing this channel and starting doing the lives, almost every single week, I've flicked up an infographic or an image of the amount of people coming off cheap fixed rate debt. Now, I understand that not everybody in the UK who owns a property is on cheap or fixed rate debt. I understand some people have their properties paid off in cash. Other people have fixed in for a while ago, for a long time. But if we look at this, okay, if I zoom in, I've always said, right, 2023 is the peak of people coming off 2% and lower fixed rate interest mortgages. And the figures, I believe, are about 1.6 million people in 2023. Now, we're still not halfway through 2023. So it's about 100, I think the figures are about 116,000 every single month, people coming off a fixed rate mortgage of 2% or less through 2023. You can see in 2024, by the way, this still continues. So it's less of a rate, but there's still, what's that? There's still 1.6 million people next year coming off 2% and less. So what we are seeing at the moment, right, is we are seeing interest rates continually going up and more people cumulatively coming off their fixed rate debt. What I understand a lot of people have been doing, looking at some pieces of analysis, is a lot of people over the last 3-4 months have not been refixing, have been sitting on a standard variable rate after they come off in the anticipation that interest rates are peaking or topping out and they're going to start coming down again. But we're now seeing what looks like quite a reversal of that. And we're now talking, as I said at the beginning, going up to 5.75, even 5, even 6. Now, we don't know that. Look, there's no guarantee that we're going to go above 4.5. Next week, the MPC might together and they might pause it. I think it's unlikely. There's no guarantee we're going to go above 5. I think that's unlikely now. Market makers saying 5.75 doesn't mean we're going to get there. But look, this is something I saw yesterday, right? Mortgage Mayhem. NatWest increases rates as Santander temporarily pulls some deals as it happens. Look, the banks, the lenders, it's kind of, I don't think they're used to things happening this quickly. And therefore, we're seeing a lot of mayhem in the mortgage market with products just being pulled straight away. Now, this is causing chaos, right? Imagine people who are buying houses, selling houses, or buying houses looking for a mortgage, and suddenly all the products start drying up. You can see what I mean about the momentum increasing in terms of what's going on here. This is going to affect things, but we're not going to see the effects of it for another 3, 6, 12 months. But we're in the lending market is in chaos right now. They don't know what to do. They don't know which way to turn. So everything's being pulled, right? When a load of things get pulled, then there's only a few lenders with the initial rates on. Everybody starts going for those. There's too much demand. To get rid of that demand, lenders pull, right? Come back with higher rates. So rates are going up. Let's have a look at the swap rate. 5-year swap rate. This was yesterday. SONIA swap rate 4.6%. Now, the 5-year swap rate is what banks will be. It's what they lend to each other, and it's effectively how fixed rate mortgages are priced. But 4.6 is the highest by a country mile that I've seen since I started doing this channel. I wasn't doing this channel in the mini budget. You can see on 12th of May, there we go, 12th of May, which is a month ago, it was 3.89, so it's sub 4%. We're 4.6% right now on the swap rates. I haven't looked today, but mortgage rates are going up. So mortgage shock, more people coming off cheap debt, interest rates continue to go up. And what this is doing, right, is it's widening this gap. It's widening this gap. I want to try and illustrate what I mean here. Okay, so I'm just going to switch over quickly to the heads down. Let me get that light on. So I've drawn here, by the way, this scale kind of means nothing. This blue line is designed to reflect the amount of people who are coming off fixed rate mortgages, cheap fixed rate mortgages, and it's a cumulative line. So you can see right now, right, we are in a cumulative phase of people coming off that cheap debt. Now, the red line, I've kind of gone to represent affordability or how much spare cash people have. And as interest rates go up, right, people's affordability is going to get squashed. So right now, people's affordability is getting squashed. More people are coming off cheap debt. And effectively, what I want you to think about is this gap, if I use this, right? This is the gap, which is getting bigger every time more people come off their mortgages. Every time interest rates go up, this gap is getting bigger. And if you look at the data, right, we are probably, kind of here right now. And as this gap gets bigger, right, as we come into here, there's going to be so many more people who are struggling and incomes are going to be, squeezed even more. We'll talk about wage growth in a sec. It gets bigger and bigger and bigger. And so therefore it compounds. The issue compounds as we get further down the line. If we look at house prices, right, let's just say, we're like there right now at this point. All right, what happens when we go into this? It's unlikely if we talk about that quantum, that different probabilities of different things happening. It's unlikely we're going to go up here. Okay, much more likely we're going to be coming down here. That's maybe a bit dramatic, but you know what I mean. So, when you look at that gap, I'm calling it the gap now that's getting wider and wider and wider, it's going to cause more and more issues for the property market. Right. let's look at the next thing that we need to consider for a property market crash: cost of living. Inflation is stubbornly not going away. This is what's caused the ripples in the market. If you look at this is core inflation. This graph. So this isn't the CPI. This is the core inflation curve of it, where you can see that. Where's my pen? Let me just grab it. It's this uptick here, right? That has really set the markets into a state of panic. Because core inflation is effectively the inflation figure when you strip out food and energy. Now, energy is starting to fall off, right? Last month, it should have fallen off the radar. Not fallen off the radar, fallen off the figures. Food is still rocketing, okay, crazily. But it's this stuff that we could say it's linked to greed inflation, wage price spiral. It's everything else, right? And it's still going up. So this is unlikely to suddenly come down. I'm not saying it won't. I'm saying if you look at a quantum of probabilities, it's unlikely to suddenly drop down. It's still going up at the moment, right? And this is going to keep compounding into our wage price wage, whichever way you want to talk about it, spiral. So this cost of living is not going away. We talk about utilities and utilities getting more affordable, and they will, right? Wholesale cost of gas has gone down a huge amount. However, this was taken a few weeks ago. This is the level here that energy companies are buying energy for the winter this year and also for the summer next year, right? It's sitting about 140 a therm. Now, last time I looked at the wholesale price of gas, it was under 70 a therm, which is kind of where we were in 2019. So actually the wholesale gas now is where we were in 2019, but companies don't just buy on the spot price, right? They hedge and they buy in advance. So the cost of gas for the next year is still looking at 140 a therm, which is twice what it was pre-crisis, and that means those prices are not going to filter down much for the next year. So the next year, utilities are still going to be high. Utilities still high. It feeds into everything. I own a scaffolding business, and my direct debit, my energy company, just put my direct debit from £400 a month to £1,900 a month without telling me, because the business energy guarantee scheme ended end of March, April. Okay, so right now, when we're shopping around for more stuff, that energy company was charging us 77p a kilowatt hour. Bearing in mind, I can top up my electric car on a motorway for 66p a kilowatt hour. That is crazy, right? But this is not going to come out anytime soon. This is going to be sticky, and so we're going to be in this cost of living for longer, which squeezes people's affordability. When we squeeze people's affordability, they can borrow less. House prices come down. It's like gravity. Has anybody got any thoughts on that before we go for the case for the case against a crash? So that's the case for. Main thing is mortgage interest rates, right? It's really causing a lot of destruction right now, but that cost of living is part of it. Anybody got any points on that before we move forward? By the way, I would also be interested to hear your thoughts on what you think the property market is going to do over the next 12 months. 12, 18 months. Find that comments box. Get the comments in. Let me know and we can have a talk about it. Let's talk about the case against a property market crash. One of the big things that people talk about with UK long-term property values is the supply and demand equation. So the argument goes, we're an island. There's only a limited amount of space. There's always going to be more demand than there is supply, and therefore that is going to push prices up. And from a macro long-term point of view, I tend to agree with this. However, I've been doing a lot of research on this over the last couple of weeks, and there's an interesting case. So there is actually no housing crisis. There is a housing crisis, but it's not due to lack of supply. Okay. So I'm going to be putting out not a live video, I'm going to be putting out a pre-recorded video where we analyse, is there actually a lack of supply that's causing the housing crisis in the UK, right? Or are there other factors at play? That's an interesting one. But I don't care about long term. For this market cycle, we're talking about short term. So we need to understand what's going on a supply demand level in the short term, i.e. the here and now. Right. This graph is from Zoopla's May HPI. So let's look. So these figures are based as of now. So May 20th, 4 weeks to 21st of May 23, and compared to the period between 2018 and 2022. Now this is really interesting. Now I get it. I get COVID is going to be included in that data set. And I don't know if they've excluded that particular data set from COVID, but we're looking at quite a long period. It's not just year on year, because a lot of the comparisons I've seen are based on 2022, where beginning of 22, where things were booming up. But this is based on a longer time period. So let's look at that. Demand, minus 14%. And again, we've probably got some lagging indicators in here, right? There's lag in the system, but demand is down 14%. Flow of new supply is up 16%. Okay. So when people talk, by the way, I'm aware I'm doing right now the case that there won't be a property market crash, and talking about the factors that people cite to say there'll never be a massive correction in the UK property market. But I just want to go through objective data. Everything, none of this is my hypothesis, right? This is just objective data we are going through. When you see demand drop and supply increase, the gap again, we've got another gap here that's widening. There is only I'll go to comments in a sec. I can see some comments coming in. There is only so much. With that gap widening, it's going to lead to prices coming down. It's just a supply-demand equation, right? You have lower demand, higher supply. It will force prices down, because it means it becomes a buyer's market rather than a seller's market. There's less people out hunting with more choice. And again, it compounds, right? Because as you have less buyers, but more things coming onto the market, right? Every buyer might now suddenly have 4, 5 to choose from, rather than every buyer having 0.1 to choose from or something like that. I know that's an extreme thing, but we're definitely seeing like an inversion of that supply-demand equation right now in the short term. If you go in, there's some great channels out there from sort of estate agents where they go through all the estate agency data. But what is very obvious is supply seems to be picking up, and interestingly, when the agents talk about it, obviously everybody who comes on YouTube or puts social media, myself included, right, has an agenda. This is natural. This is obvious. Agents' agenda are to get your listings to sell properties. They need to sell properties to make money, right, to pay the bills and to make a profit. When an agent talks about increase in supply, they talk about it as a good thing. It's like, look, this is great. Agency world is all fine. We're seeing more properties come onto the market. These properties, more properties on the market, more sales, more income, more profit for the business. However, I've always said that the thing that's going to tip the balance in this housing market cycle is an inversion of the supply-demand graph. So when supply goes up and demand goes down, that's when we're really going to start to see an acceleration of the dip in this cycle. And that appears to be what we are seeing right now. Okay, and we have been for a couple of months, to be honest. Again, lagging indicators. So we don't know what's going on today. There might be no supply and loads of demand, or there might be literally, you might be having loads of stuff coming onto the market right now and the demand is falling off. I know from my area, I've said it a few times, I'm seeing more for sales signs in my area. And I live in a relatively affluent area with sort of larger properties. And I've been quite surprised walking around how many for sale signs I've seen recently. Okay, if we look at this is another interesting graph from the same HPI, from Super HPI. This is regional view on demand and sales agreed, right? So I don't care too much about the sales agreed. Let's just look at the demand here. Southwest, right? Demand has fallen 30%. That's incredible. The only place that's in a positive right now is Scotland. And I've got to be honest, I'm not hugely au fait with the Scottish market. It's not something I operate in. It's a fairly different market to the English market. I do know there was a big sort of downturn recently. So I don't know if we've got to bounce back right now. But this, I would say, is almost certainly skewing the data for people who live in England and Wales, right? If anybody is in Scotland, by the way, let me know what you're seeing in Scotland in terms of that sort of sales agreed, what's going on in the property market. I don't know. I know there's been some political things going on in the Scottish market. But yeah, look, if you take away Northeast, right, and that, everything else, right, minus 30, minus 25, I mean, minus 20 is, it's a massive drop in demand, team, massive drop in demand. Great, so that's supply demand. The next thing, right, that people are talking about in terms of a soft landing, soft cushion for the property market is wage growth, right? Figures came out yesterday, and this is really interesting. Figures came out yesterday about the current wage growth, which is strong, but is it? I just want to show you an image, right? I took this when I Googled, when I was researching, I put in wage growth, news, and these are the first two things that came up, the first two headlines that came up. Headline number 1, UK wage growth rises at fastest pace in 2 years. Headline number 2, UK average wages rise at slower pace than inflation, causing fall in real terms. How can anybody make any decisions, right? How can anybody make any decisions when you've just got such conflicting headlines out there? Last week, I talked about a couple of psychological terms called cognitive dissonance and cognitive shortcuts. And what we do as humans is we've got so many things, so many decisions going on in our brain all the time. We tend to skim, look at headlines and make decisions based on that to shortcut the decision-making process. Now, when we have all of this stuff coming in that's conflicting like this, it makes life very confusing, very overwhelming. It puts a lot of anxiety and people don't actually know where to go, what to turn to. What's the actual picture? What's actually going on? Here's how I see it. So wage growth is high in nominal terms, right? If you look at nominal terms, I can't remember what it is. It's 7%, something like that. Nominal terms is not inflation adjusted, right? To look truly at what's going on with people's wages, you have to look at inflation adjusted wages. So when you look at inflation adjusted wages, they're negative. So we're in this weird paradoxical world at the moment where the nominal figures are really high, right? Very strong wage growth. But we're actually getting poorer when we relate it to inflation. Yeah. So there you go. In fact, this headline actually says wage growth by 7.2%, but actually inflation adjusted means wages fell by 1.3%. And I read an article recently that talked about right now, right, over the last year, inflation adjusted wages have fallen at the greatest rate in 20 years and actually make us worse off than something like the 70s. We were in the 70s, something like that. We're the worst off in terms of affordability, inflation-adjusted affordability than we've been since the 70s. That was roughly what it was. So, yes, wage growth is strong. Now, at some point, this will flip-flop, by the way, because wages have gone up. At some point, the inflation will stop going up, and if there's an overshoot and wages carry on going up, then we'll become richer again. However, inflation coming down does not mean that it's actually coming down, if that makes sense. Inflation coming down, unless it goes negative, means it's going up at a slower rate. And people still seem to, I think a lot of people, and especially media commentators, mainstream media commentators, miss this fact that they think inflation coming down, let's say inflation next month goes down to, I don't know, let's 5%, right? Rishi's target. People go, yeah, inflation's coming down. It's not coming down. It means it's now going up at 5% a year, which is 5% on the 10%, or 11% that went up last year, which means it's compounding up. So if you compare where we were 3 years ago, you're now sort of 20, 30% more, everything's 20, 30% more than it was 3 years ago. So inflation coming down doesn't mean things are getting cheaper. Just means they're going up at a slower rate, okay? So make sure we don't fall into that trap. But here's the thing. Let's look at headlines like this. The government need us to go into a recession, right? To get rid of inflation, we have to have a short, sharp reset. That's what they're trying to do. Government, Bank of England, trying to force us into recession. We're in this, as I said, this paradoxical phase at the moment, if you like. I'm just going to come off this. We're in this paradoxical phase right now where because of inflation, because of the wage price spiral, price wage spiral, whichever way you want to talk about it, because there's that sticky inflation, right? It's carrying on. People are demanding more wages, right? As they would do, more wage increases. Wages go up. So it looks like we've got really strong wage growth. The only way to get rid of this is to put interest rates up more, even though paradoxically, we're actually all becoming worse off because that wage growth is below inflation. So you've actually got a wage growth that's below inflation, so we're becoming poorer in real terms, but with interest rates continuing to go up to get us out of this sticky cycle. So again, it's a double whammy. That gap is widening for everybody. It's a slightly, I'm actually starting to look at this and go, this is a slightly concerning situation for us as a country to be in. And look, I want to caveat, I'm not an economist. Absolutely not an economist. I'm a fighter pilot, a property investor. So I might be talking absolute rubbish here, but as a layman, I look at it through a layman's set of eyes. And it's like, well, what's actually happening here? Where are we going with this? Because with this strong wage growth, right, this is where now again, we're talking about interest rates going up again to 5.75, which makes that gap bigger, and it all becomes cyclical. Interesting times. So look, the final thing that I want to talk about in terms of the case to not go into a property market crash is GDP, right? Which again, yesterday figures came out and everyone's like, oh, it's so much stronger than we expected it to be, which is interesting. So let's have a look at that. Headlines yesterday, UK to avoid recession, a stronger growth forecast. Let's look at that picture, right, of what's actually happening with our GDP. I don't know about you, right, but that does not look like a particularly healthy line in terms of our GDP. So we had the V from COVID, okay, and it's flatlined. Like literally, GDP has we've flatlined at where we were pre-COVID. Now, let's just think about this for a minute. GDP has flatlined. What's happened in the last few years since COVID? We went onto a massive quantitative easing program, printed billions, if not trillions of pounds, or created it, pumped it into the system, and interest rates were slashed to 0.1% or whatever they were. And all of that stimulus has flatlined GDP, right? So what's happening now? We've reversed it all. We're in quantitative tightening. Money's coming out of the system. Interest rates are now spiraling up quite quickly. And here's the issue. And again, look, the headline. So that headline I just said, UK to avoid recession, a stronger growth forecast. These are forecast by, international consultancies, KPMGs and things like that. I'm not going to sit there and disagree with them. But as a layman, I look at this and I say to myself, is that really going to happen? Because the interest rate lag on the economy is about 18 months, right? So when an interest rate rise happens, we feel the effects in 18 months' time. So I get it. If we feel like we've peaked out on interest rates and they're on the way down, we kind of go, yeah, okay, cool, I get that. But they're still going up. So this lag is still, we're still not at the peak of it. We might not be at the peak of it. If interest rates continue going up this year, 2023, into the beginning of 2024, right, we might not feel the effects till 25, end of 25, maybe even 26. I don't know, but it doesn't feel like a particularly healthy place to be. And as a business owner myself, I own a scaffolding business. I'm seeing the effects of this. I'm seeing the effects of interest rate rises on debt. I'm seeing the effects of wage price spiraling. We've got a workforce where there's a supply-demand imbalance of workforce. And because there's a lack of supply of workforce, the people that do work are demanding higher wages, right? And I can see it happening in my own business, that we have to do that to keep a workforce. Otherwise, they go and work for a competitor, we'll give them more, charge higher. Interesting, right? Interesting. Here we are in terms of all of our peer groups in terms of GDP growth up to the end of 2022. Look at that. That's a nice shining beacon for UK, Brexit and all that sort of stuff, isn't it? And again, this is where we are in terms of quarterly performance. If I had to bounce back in sort of mid-21, it's not particularly stunning in terms of where we are. We're definitely flatlined, and people talk about avoiding technical recession. I'm not particularly fussed if it's a technical recession or not, right? If you have a quarter that has a little uptick of 0.1%, which means we can technically not say we're in recession. Let's have a look at this in 12 months' time, right? See where we are. What happens in recessions? Recessions obviously means the economy shrinks, GDP shrinks. It's tough for businesses. They generally have to lay off staff. Okay, that's what happens in recessions. There's less business to do, shrinks, can't grow, lay off staff. Here's the government's projection on unemployment, and this was taken a few weeks ago, so this could be out of date now. But if you look at the fan chart here, this is from their own website, potentially, there's a bracket there that it could hit, what's that, 7%, and it's, by end of 2026. Not a massive one, kind of more likely going to be sitting here. And the middle is about 4.5%, which is higher than it is now. So let's just follow it through. They're trying to force us into recession, right? At the moment, one of the things that people are talking about that is propping the market up is the stronger than expected GDP, stronger than expected labour market, right? And wage growth. Those are the things being cited as propping the property market up. If interest rates continue to go up, right, and they force us into recession and people start laying off employees, right, and unemployment goes up, these arguments no longer stand. And remember earlier when I talked about the momentum, right? Inching, capitulate. Are we going to find ourselves in that sort of scenario? Again, look, I'm just presenting data and quantums of what could happen. Equally, we could be sitting here at 2%. It's possible. Let's see where we go with it. So, where does this leave us? Housing market versus recession. Interesting infographic I found, because right now a lot of the media is talking about strong strong economy, or not strong, stronger than expected economy, strong wage growth, right? And that seems to be causing people or taking people a little bit by surprise. But the property market, as we demonstrated earlier, is starting to be on its way down. If that accelerates, if that housing market dip accelerates, our economy and the housing market are intrinsically linked, okay? And look at this little schematic, say why. House prices fall. When house prices are falling, people feel less wealthy. Okay, confidence dips. Remember earlier we talked about psychology of all of this and sentiment. Psychology, sentiment dips, people spend less, right? Creates the fall in GDP. And it's all cyclical, it's all linked. And because it goes round in a cycle, this is where we start to see that compound effect, if it keeps going round, of accelerating away and going into market capitulation. Again, let's just show this, right? Here, we've got a little uptick, capitulate. This could happen. I'm not saying it will do. I'm saying the further we get into this, if house prices continue to fall, that sentiment psychologically will really start to drive behavior. And I'm seeing on the shop front, right, out there, I run a program, I mentor investors on a program called the Property Cashflow Accelerator, working with people who are out on the shop floor every day looking at properties, pipelining properties, and we're seeing some significant drops in property prices, generally based on landlords leaving the market and commercial style sales. Less in the homeowner, but that will follow. Landlords, commercial, always going to be more sensitive, right? And they're fleeing the market now. Homeowners, residential homeowners will be later in the cycle, but when they start all putting them the properties on the market, it could then go down quite a lot. So look, what next for investors? By the way, if this is useful, team, I will answer a question actually. Let's just see what we've got. If this is useful, can you give me a thumbs up and let me know that it is falling well? Sorry, I've gone on quite a long time. It's 45 minutes into this already. I do apologise. Facebook, I think there'll be a slight correction due to mortgages and cost of living, as you mentioned. I think the government will try to prevent a crash. I'm not sure how long it will last. This is very interesting, right? I don't know who's put that comment in, but it was something that was going to end on this. I'll say it now because it's there in the comments. Some people are talking about 30 to 35% nominal drops, which nominal is the ticket price, right? Versus inflation adjusted, which will obviously be more because we're in a high inflationary environment. I don't see that. I don't see 30% drops. I'm not saying it won't. It's definitely a probability on the quantum of probabilities. Okay. I don't see it right now because I don't think the government, exactly what I was going to say, I don't think the government will let it get that bad. I think there'll be third-party intervention before we see 30% plus drops. Now, interestingly, if we get to that part of the cycle and the government have to intervene, what they're doing is going to be putting more air into the balloon. Speculative people will be able to make a killing out of that. If some form of government intervention and support comes in, right, those people who are in the right place at the right time will make a killing if they understand how it all works. But by putting more into it, I mean, you could just keep putting more air, go pump up, deflate forever. At some point, it might well pop. That's my thoughts. But let's talk about what happens next for investors. Okay. I saw this article and it kind of it stood out for me because there was a quote from Liam Ryan, who I know, who runs a property training company, and I also want to talk about this in terms of cognitive dissonance and cognitive shortcuts. So, if I can let me see if I can highlight it. However, when you embark on property investment, you have to be in it for the long term. Property will always bounce back, and ultimately we see a lot of areas in the UK double in property prices over 10 years. The average countrywide is 7%. It's an interesting thing saying, by the way, I completely agree with the sentiment. We'll go through cycles, right? It'll go down, it will come back up again. I think we have to be careful about putting blanket comments. One of the standard guru comments is property doubles in value every 10 years. This is actually a complete lie. And I'm going to do, I want to give you a bit of analysis on this right now. So if we look since the 1970, right, this is where most people take their data from, 1970 to now, right, if you look at it on average, we've gone up about 7% a year, which does mean on that basis that property prices double every 10 years on average. However, the first thing, let me just go over here actually. Let me go back to the actual property price. Oh. If we go back to the actual property prices. Or in fact, let me go back to that. That's probably good, right? If we get in here, it's not going to double in 10 years. If we get in here, it's not going to double in 10 years. If we get in here, it's not going to double in 10 years. So it's not just a stick your money in and in 10 years' time it's going to be doubled. I think it's a really dangerous message that goes out into the community, right? Also, and I've been doing quite a lot of research into this, this graph, again, this is from UK HPI. This is the monthly change, right, in house prices since 1970. Right, and if I draw a line down the middle, right, you look at that side versus that side, look at the size of those percentage increases on a monthly basis, right? Big. These are big increases. These are small increases, okay? Let's just go to the next one, which is year on year, right? This is UK ONS data. Let's just cut it down the middle, right? This is year on year changes. This side, i.e. 95 and before, big changes. This side, 95 or since 95, small changes, right? Without a doubt, what we are seeing, that's not a very good line, sorry about that, is a compression or a decline in the peak to trough of the UK property market, which I think is really interesting. And I'm not saying it's not going to go back up again. There's no guarantee it will, but it will do, right? But I'm saying don't be stuck into the trap as an investor. Just go, right, stick your money in, 10 years' time, it's going to be double. If we look at this in November 22, so I've gone peak of the market of our current cycle was according to UK HPI, so not with Rightmove or Halifax or Nationwide. When you look at the ONS data, peak of the market, and it's got a lag in it, was November 22, 292 grand average in the UK. Take it 10 years before, 169, and then 10 years before that, 121. Right? If you do the figures, that is not double. And that, by the way, this is 2012 to 2022 is pretty much, it's not trough. We've kind of come out the trough of the financial crisis and flatlined for a bit. But it's pretty much the whole run up from almost the bottom to the peak. Double 170 is 340. So we're not at double in 10 years. Again, November 2002 to 2012, 121. Doubled is 240. We're not doubled. So this myth of property price double over 10 years is a dangerous piece of rhetoric that I feel people put out into the market with an agenda, right? And I do not want people to fall into the trap of going, let's just go in now, right? Because it will double in 10 years and everything will be good. Doesn't work like that. What we need to do in the current market is be more sophisticated as investors. And we actually need to just sideswipe the entire market dynamics, right? Sideswipe interest rates, sideswipe valuation, like normal. So everything we look at here is residential valuation methodology. If we look at different valuation methodology, for example, commercial yield-based methodology, which actually mean our values could be going up if the rents are going up because it's a multiplier of income when you use a yield-based methodology. There are various mechanisms, strategies we can use to just bypass all of this. So as a professional property investor right now, I mean, you might want to hold your powder dry and see what happens, but I'm buying right now. Yield-based methodology, long-term hold. My clients are buying or putting offers on things right now, getting some seriously cool offers going in. This is going to, if we look at momentum and cash flow investing, right? So be able to buy at a certain value, add value with various mechanisms, toolkit of mechanisms we can do that, right? And add value that is completely dislocated from the property market itself, right? We don't need to worry about house prices. And then if we can cash flow them, again, completely dislocated from the normal market, right, and get a return on capital that's extremely large, this is where professional property investors are going to clean up. So don't worry if you're an investor about prices, residential house prices, right? This whole model is something called a hedonic regression model. It's kind of just a bit made up to give an indicator of what's going on. We just don't care. I've never cared about what the market's doing in terms of my values of my properties going up. It's all about the ability to buy well, add value with a toolkit. Right, recycle funds, not too much because of interest rates right now. We have to, but preserve cash flow, right? We do all that. That is where we make our money in the current market. Whew. I think I'm done, guys. If anybody's been here for the whole 54 minutes, I applaud you. And if you've watched the whole lot on the replay, I applaud you even more. I appreciate it. So I'm going to wait for a couple of minutes, see if you've got any questions on that. today's live was actually meant to be just a 5 to 10 minute state of the market before next week's news. I think all hell's going to break loose next week. Although, you know, the interest rates have been priced in already, but when it actually comes in, we'll see what happens. I'll be interested to see what UK HPI does. By the way, with UK HPI, we'll expect a little uptick at some point. Because when we look at the sentiment uptick that we had with Halifax and for 1 month of nationwide over end of winter, beginning of spring, I'll expect that to be reflected in the UK HPI. When it comes in and there's a little uptick, right, and people go, oh, there we go, we've hit the base, going back up again, just be careful. Let's just be careful about that. Over to you, team. Any questions? Any questions from you? Before I go and get some lunch. It's interesting, the comment we got from Facebook, which is, I know one of my groups, slight correction. I am personally starting to lean towards a deeper, more worrying correction. But we'll see what happens. At some point, I'll do a video on what I did last year, which was kind of saw this coming, actually, when we started to go into the cost of living crisis, saw this coming and sold my own house and went into cash as a war chest to buy. So there we go. That's where we are. All right, team, I'm going to leave you to it. It's been an absolute pleasure. I'll see you next week. I'll probably go live after the MPC meeting next Thursday, and we can talk about interest rates, see what happens there. But otherwise, enjoy the Scorchio weather. It's lovely. Don't get too hot, and I'll see you next week.